So before we get into our fantastic interviews this afternoon and for this show, thought we would touch on our usual, our very popular segment, our top three things to consider before you make your investment decisions. And you can see the list up right now: geopolitics, upswing, and the markets. You can't help but to be caught up in all this geopolitical rhetoric, whether it's about Greenland, whether it's about Iran, Venezuela, the talk, even the simple talk about the Fed and the head of the Fed being, before, I guess, perhaps a jury to explain all the different things and the construction that's going on at the Fed right now. A lot of things going on between the Trump administration and various parts of the world and within the United States themselves. So we talk about geopolitics and how that is affecting the market. Earnings season gets underway. It's been underway now probably for about a week and a half, and started with the big U.S. banks, moved to some of the more smaller banks, some of the regional banks, super regionals. Bank earnings have come in quite nicely. Now we're moving more into tech. We got our first big cap tech name just last night report earnings. That was Netflix. We're going to talk about earnings season. And our third topic: investors seemingly tired of tech stocks. Just seems like no matter what news we get, whether it's Taiwan Semiconductor, the largest chip producer or chip maker in the world, they produce chips for companies like Nvidia and Apple. When they reported great earnings, market really didn't move too well. When we hear good things out of Nvidia, market doesn't move an awful lot. Are we starting to get tired of the tech stocks and that sector? So we're going to touch on that as well. So let's move forward with our first topic: geopolitics, upswing in the markets. And we've been getting a lot of questions, obviously, about geopolitical events that have been in the headlines over the last, let's call it, month or so. We've heard, I guess, initially about Venezuela, and then the removal of their leader, and the United States running Venezuela, at least for the time being, until government is put in place. We also heard about tariffs being put on any country doing business in Iran. We heard about all the instability going on in Iran. And most recently, I've been receiving a bunch of questions from investors about the whole Greenland situation, the idea that the United States is wanting to own Greenland, wanting to purchase or take over Greenland. And I think that the worry has been that if Greenland does not want to be bought, would the United States take over Greenland by force? And I've said to many investors already that I highly doubt that the United States would attack another NATO country. NATO is the United States is responsible for the majority of the money spent on NATO to protect the world's countries that are a part of NATO. And I highly doubt that you would see the United States attack Denmark or European countries with respect to wanting Greenland. But I guess that was what the market was nervous about. We heard the president today in his speech in Switzerland, Davos, Switzerland. He mentioned that, no, he's not going to attack Greenland by any means. He wants to negotiate. He wants to acquire Greenland. And if, I guess, the Europeans do not allow him to do that, then he would be quite unhappy. And what does that mean? Well, we're not exactly sure. But heading into 2026, there was a survey done. We can pull up our first chart. And you can clearly see by our first chart that geopolitical or geoeconomic confrontation was the number one risk heading into 2026. You talk about geopolitics in general, you have geoeconomical confrontation, 18%, state-based armed conflict, 14%. So geopolitical worries make up 32% of the people surveyed. This was done, nearly a fifth of the respondents in the World Economic Forum's Global Risk Report cite geoeconomic confrontation as the biggest immediate risk in 2026. And you can see all the others a lot lower than those first two: weather events, societal polarization, economic downturn, adverse outcomes of AI technologies, et cetera, et cetera. So geopolitics has been on the mind of many. And I have to say that a lot of the geopolitical volatility is definitely coming out of the Trump administration or out of the United States. It seems as though President Trump has had a lot of goings on, to say the least, a lot of issue with the likes of Venezuela and Iran, and talked about perhaps going in and doing something with Cuba and Colombia and other countries like they did with Venezuela. Talked about Iran and the instability there and the uprising in Iran, trying to protect a lot of those protesters, as we've seen some of the horrific pictures as to what has been going on there. And now Greenland and their aspirations, the United States aspirations of taking over Greenland, and not to mention a lot of other commentary that the president has made about countries like Canada and France. So geopolitics has been on the minds of investors, and I think it should be on the minds of all of you as well. The geopolitical headline can do a lot to move markets. But for those of you that have reached out to me and said, I'm really nervous, how's this going to affect our markets? Should we be selling out of the US? A lot of these things I heard back last spring. And for those that didn't panic and stayed the course, continue to own good quality investments, both in the US and outside the US, as we know, last year, you made out quite well. Our next chart clearly shows this. The US stock market powered through a roller coaster year in 2025. There you have the Trump tariffs, the tariff pause, and then the markets just took off from there through the bombing of Iran, through the crypto situation or dive that we had towards the end of last year. The United States, the S&P 500, ended the year at pretty much all-time records, just under 7,000 points. However, it was a bumpy ride. So the market did climb that wall of worry last year, just like I guess the market's doing when I came on the air at noon today. The market seems to be climbing yesterday's worries. And we have a chart of just how bad the markets fared yesterday. There you have it. The S&P 500, Dow, and NASDAQ down anywhere from 2.39% to just under 1.8%. So pretty negative day. And here we have the next day, President makes a speech in Davos, Switzerland, to the World Economic Forum, and markets are rebounding from yesterday. And it's interesting, in his speech, he mentioned how the United States is doing so great. GDP is up, inflation is down. He mentioned that they're doing the best. A lot of it has to do with some of the policies he's put in place, some of the tax reductions, eliminating red tape, and obviously he talked about the tariffs, making America great again. Well, interesting enough, our next chart shows that, well, making America great again, he did. U.S. markets were higher, but as you can see here, markets around the world fared a lot better than the S&P 500. There you have the German DAX, Japanese Nikkei, and even Brazil. And we talked about this on our last show, how the world markets actually fared better than the U.S. market. So making America great again ended up being making everybody great again, which I guess the president could brag about and could be proud about doing. Our next chart, we go to the 30-year Treasury bond rate in the United States. The president and his administration wants to see interest rates coming down. When you have volatility like we saw yesterday, uncertainty like we saw yesterday, there is this fear that other countries will no longer or stop buying U.S. debt or even sell U.S. debt. There was some talk of that yesterday, and that caused the 30-year Treasury bond rate to spike to 4.92%. More importantly, it caused the 10-year, which is our next chart, to spike to 4.29%. We have that chart there as well. And as we know, the 10-year is what mortgage rates are based on. So if we get a spike in the 10-year, there's a good chance that mortgage rates, fixed mortgage rates, will move higher as well. So geopolitics on the minds of many investors today. I'm hopeful that today's speech by the president, although being a little bit confrontational as he was, if you heard his speech this morning, I did. He called out many world leaders, many different people, but he also said and gave some assurances that he would not take over Greenland by force. He's hoping to negotiate. So that was a positive, and I think on that sentence alone, the markets turned to the positive, but definitely something we need to be focused on. Our next, I guess, topic is for the top three things that individual investors need to focus on as earnings season. And So earnings season started off with the big banks in the US. Best big bank earnings was Bank of America. We have our first chart, which is on Bank of America. And I thought they had the best chart. Actually, our first chart is on the US financials as a whole. We can come back to Bank of America. Our US financials ETF clearly shows that that sector has done extremely well and continues to power ahead. But as you can see, Bank of America sold off on its earnings report. And like other major banks, it just seems like when big banks report earnings out of the US, more often than not, it's a sell the news phenomenon. They buy the rumor. So the Bank of America actually hit as high as $57 a share, over $57, and quickly lost 10% after earnings were released. Another chart we have here, which is JP Morgan. JP Morgan is our bank chart, also shows that this stock lost as much as 10% when they came out with earnings. Also, I thought very strong earnings. I thought that, you know, there was a cautious tone to Jamie Dimon, the CEO of JP Morgan, but he always seems to carry a cautious tone. He's concerned about, obviously, things such as inflation and world events, more so. And I think that may have led to his stock coming under pressure. As we now transition from bank and financials, we had some of the super regionals, PNC, US Bancorp. I thought earnings were okay over the last few days. We're now moving into tech and the tech sector. We have a chart on the first company, the first big cap tech name to report earnings, which is Netflix. And I thought Netflix earnings were just okay. They beat the expectation by just slightly. I thought their guidance was weak. You know, their subscriber growth was good, but their guidance going forward, margins was I thought a little bit disappointing, and I think the market felt that as well. There were some reasons for that: increased costs for creating some of the content that they do, that they're so good at. But those costs are definitely rising, and I thought that was a bit of a negative. And so their guidance going forward overall was a bit disappointing. But you can clearly see that this stock has had a pretty large pullback from well over $130 a share down to under $90 a share. And last night, after they reported earnings, the market did not really like them either, and the stock pulled back as well. But as we move into the rest of the tech space, we have a chart on the Mag 7 stocks and how they're performing. And actually, I would say that some of these big cap tech stock names are actually in a good spot because they're heading into their earnings reports over the next couple of weeks on a bit of a down note. You know, Apple down 10% this month, Meta down, Microsoft, Nvidia, Tesla, the Mag 7 in general down 4.5%. Obviously, their one-year numbers fared a little bit better, although Alphabet and Nvidia carried the group. All the others were sort of flat, maybe even slightly negative on Tesla. You look at a 5-year number for the group, obviously much higher. Again, Alphabet and Nvidia. Nvidia really carrying the group to 132.5% gains for the last 5 years. So I think you want to look at earnings. Tech earnings are going to be so important to how the market fares. And we're going to get some tech earnings from the likes of Microsoft and Meta next week, followed by Apple, and then eventually Amazon and the rest of the big cap tech names. So keep an eye on earnings season, tech earnings, because they're going to be very important. Our last topic that individual investors need to focus on before they make their investment decisions, to me, is this idea of, are we just getting too tired of a tech? Are we talking too much? You know, I don't really hear much about the Mag 7 as a group anymore. A lot of the good results, the price of stocks going higher, not only is it in the Mag 7, but it's a lot of other tech names as well. But perhaps individuals are starting to grow a little bit tired of just the tech sector making all the gains. We have a chart here that shows that gains are actually happening in other sectors, broader gains happening right now. Recent U.S. stock performance shows broadening of market leadership. The actual number one sector over the last little while has been healthcare. That's the green line, followed by the small cap index, industrial sector. Then you have the overall S&P 500. And as you can see, below the flat line is the tech sector. And that is, in the last couple of months, that's what we're seeing. Tech underperforming other sectors. And have a few charts of some tech names that will clearly illustrate this. Our first chart on an individual name is the biggest tech name that exists today, which is Nvidia. If you look at the Nvidia stock, there you have it. And you can see it has not performed well ever since that spike, I guess, in November. It has come down quite a bit, all the way. I think its high was somewhere around 210, 212. Now it's trading under $180 a share. Our next stock, another Mag 7 name, is Meta. We pull up a chart of Meta. You could clearly see that Meta, too, has had a bit of a difficult time. Their high was somewhere around $800 a share, and now they're trading almost $200 below their all-time highs. Next chart, Microsoft. Microsoft, once a $555 stock at its high, now trading about $100 less. So you could clearly see these Mag 7 names, for those that were saying they were overvalued, that they were, their PE multiples were just out of, astronomical. Yes, perhaps a couple of them have high multiples, but you could clearly see that a number of these Mag 7 stocks are actually trading quite cheaply. Thought before we move to our next segment that we would focus on some non-Mag 7 tech names, and I have one here, IBM. IBM had a tremendous run over the last bunch of years, but you can see clearly since November, IBM has been trading in what we call a pretty defined trading range. Our last stock that we have is one that shot up after earnings a couple of quarters ago, and really since then has come down, and that is Oracle. Oracle, one of the biggest tech names in the world today. You can see how badly, unfortunately, the stock has done. And our last chart for this segment, profit potential. And again, we can show, yes, even though technology has the largest profits, still by quite a bit, a lot of the other sectors are following behind it. Materials, industrials, consumer services, financials, utilities, these are all doing quite well as well. So are people starting to get tired of tech? Perhaps. Are they moving into other sectors? Perhaps. As we always say, a cause for diversification. Everyone should be diversified. Stay diversified, because even with technology and the successes we've seen and the successes we are still going to have, you still need to be diversified into other areas, because as we're seeing over the last couple of months, when tech stumbles, other sectors pick up the slack. And so staying diversified always makes sense. And as I said, you want to take a look at these three things: geopolitical events, earnings, and the tech sector running a bit out of steam a little bit. I think those are the three things you want to look at before you make your investment decisions.